Hello and welcome to this edition of All About Your Company. Today we're going to be talking about transmission and distribution player, Skipper Limited. And Q1 numbers were slightly on the softer side when you're looking at the overall FY27 guidance. We're trying to get a sense as to what's played out and what the outlook for FY27 could well be, whether there are any changes there as a result of the Q1 performance. FY28 is expected to be really strong, and therefore we'll try and build in what plays out over the next couple of years, basis what analysts as well as the management is suggesting. But first off, as we always do, take a bit of a step back. I mean, the recovery in the stock price has been very strong, but we'll try and assess as to how this plays out. It was founded in 1981. It's a Calcutta-based company, or Kolkata-based company. Sadhu Ram Bansal is the founder of the company. It's run today by his son, and we're going to be speaking with the owner family of the company. We'll have Sharan Bansal come in and speak to us in just a bit. Essentially, what this does is it makes steel power line towers and plastic pipes. This is used in both telecom as well as power transmission and distribution. It has a market cap of around 6,000 crore. It's one of the top three T&D players in the country. Actually manufactures the transmission towers themselves in-house, and that's where the capability essentially resides. Let's talk about the story. It's obviously the big beneficiary of the India power grid build-out story, and it's among the top three tower makers in India. The products that it does, and first the split. The first segment, engineering, contributes around 78% of the top line. Infra is around 12%, which is essentially EPC. And then there's polymers and others. And that is roughly 10% of the business. That's the rough breakup in terms of revenue coming from various segments. Let's talk about engineering first and give you a breakdown of what exactly are the products and services it does. First off, it does transmission towers. Doesn't need too much in terms of, let's actually flip back for a minute. What it does in engineering products is transmission towers, which is both the towers themselves, which are those rectangular towers, as well as monopoles, which is the single pole towers which get manufactured. The company does both. It does distribution poles carrying lower voltage current or power into neighborhoods, local neighborhoods. It does railway structures as well. Aligns very well with the business. On the railway tracks, all of the infrastructure that you see, the power lines that hold up, all of that they do. They also do solar mounting frames, which hold panels at the right angle. They do high mast poles, which light up highways, stadiums and yards. They also do scaffolding and steel tubes. This is all sitting within the engineering products segment, by the way. Fasteners and accessories, which are bolts, nuts and clamps for towers. And last off, they do tower testing as well to ensure that the towers actually survive wind, rain, weight and the like, right? All of that is necessary. Now let's talk about the 12% revenue component, which is infra. Now here, this is essentially EPC. And EPC is engineering, procurement and construction, which is turnkey solutions which it provides to its customers. Here, the transmission line is set up by Skipper themselves, where they design, they build, as well as they switch on the power lines for the customer that they have, or the project that they have bid it for. When you're looking at the other piece, it's substation EPC also that they do. Now, this could be big because you're seeing a large pivot towards newer substations that India requires as part of the grid build-out that India is doing, and this could be, therefore, a big opportunity. Telecom EPC, that's the other big one. There's plenty of investment happening on the telecom side as well, and there the margins are also slightly better. Water infra is the other piece which they do, water infra EPC, and horizontal directional drilling, buries cables without digging up roads and the like. All of that is what all of that is also being done by Skipper. When you're looking at coating services, galvanizing services, painting, and stopping steel from rusting, all of that on the existing infrastructure is also what Skipper does. Last off, there's polymer. The polymer and the dripping division, which is polymer is around 9% of the top line of the company. This is basically UPVC pipes, CPVC pipes, HDPE pipes, which is flexible pipes and the like. They also do sewer pipes. They do agri and borewell pipes, water tanks, and your bathroom pipes, all of that is covered here within the polymer division. And drip irrigation is also something that they ventured into. It's a very small segment relatively. They're doing it through a JV at this point of time, but that could also grow eventually. When you're looking at the business model, let's first talk about the engineering products business model. What they typically do, let's go all the way back if we can, a few slides back. And what they do there is they first buy steel, they roll it into angles, and the main buyer for them is power grid, state utilities, telecom firms, and railways. This is where a predominant, I beg your pardon, part of the revenue comes from. 78% of the revenue comes from here. And 90% of this revenue is India linked, 10% is exports. The exports happen to over 50 countries, so it's very well diversified. The goal is to increase the export pie. If they increase the export pie to maybe 50-50 from the 90-10 currently, then your margins start to go up by at least 100 to 200 basis points. This is where the margin lever actually lies. So if they're able to do this, the margins automatically go up. Infra. Now here they win orders from the government, which is EPC technically. They win orders, they build projects, they design, buy, construct, everything's on them. And of course, it suffers from its set of risks. Bad weather and land delays obviously are big risks to execution of EPC projects. And this is where some of the receivables also get locked up. Polymer is the last one. They buy plastic resin, they manufacture pipes, and they sell under the Skipper Pipes brand. Now, 30,000 shops sell the Skipper Pipes brand across India. You've got 40% of the Skipper brand which is sold to agri-related pipes, and 60% is household, drainage, tanks, etc. So that's really the breakup. Last off, they have a 9,200 crore rupee order book, 80% of which is domestic transmission and distribution, 11% is non-transmission and distribution domestic, and the balance 9% is exports. That kind of rounds up the order book. Let me now talk about the numbers itself. Now, when you're looking at revenue growth, it's grown at 41% 3-year CAGR. So you'll see some very sharp growth coming in, and the order book still is well above this threshold. So there's no concern there. Also, the opportunity continues to remain very large, so they can continue to grow at a healthy pace. Look at EBITDA, it's grown at 44% as operational efficiencies have kicked in. Of course, a couple of new segments weighs down on that EBITDA number, including the polymer section, division, which has a single-digit EBITDA margin. Look at net profit, it's gone up by 81% on a 3-year CAGR basis, and you'll see some very sharp spikes on a very low base on the profit after tax. Now let's talk about the Q1 numbers. This is where there is softness. You look at the revenue growth, it's just been 4%. The EBITDA growth has been 10%, so you've seen some margin accretion happen, but still nowhere close to the 3-year numbers that we were looking at just a few minutes ago. And the profit number has gone up by 27%. So you've seen some profitability driven largely by margins, and some amount of debt pay down also happening as a result of a QIP, which should likely benefit the profit number even into FY27. But the 4% growth looks a little soft, right? So we'll try and understand from management as to what's played out. Let's talk about margins now. And margins have clearly gotten better in Q1. And you'll see an uptick slowly as the old book matures. The old book goes away and it makes way to the new book. Apparently, pricing is more dynamic there, and therefore the margins will be better as the new book starts to mature. When you're looking at the order book trajectory, it's FY26 order book was at 8,500 crore. They do maintain a 1.5 times book to bill, which is trailing 12-month revenue to the order book. That is around 1.5x, so no concerns. Currently sits at around 9,200 crore. So there's been good accretion as well. When you're looking at the balance sheet, you've got a book of around 1,500 crore book value, and it's a 6,000 crore market cap. So 4 times book is what this one trades at. The borrowing number is around 922 crore, out of which around 450 crore would be repaid because there has been an equity issue. So you'll likely see a pay down of this borrowing number very quickly at the end of H1. And then you've got cash bank balance of around 32 crore. No problem per se with the balance sheet, but that debt number looks a little inflated. Even at 450 crore will still be quite large, right? So pay down of that is something that we'll continue to monitor. Let's talk about cash flows now. Here, the problem is that there is a lack of recovery because of government orders that EBITDA is not translating to free cash flow. This is a clear problem, and which is why you're seeing a a clear conversion not happening. Also, there is a large debt. So around 200 crore of interest cost is built into that EBITDA number at the end of FY26 as well. And that weighs down on the cash flow from operations, EBITDA to cash flow from operations conversion. That conversion doesn't happen as a result of that. So, but we continue to track this. Some receivables going on and off is always likely, but whether a sustainable conversion can continue to happen is really the question. Let's talk about return ratios. The ROCs are very healthy at 20% plus, but the ROEs are sub 15. So something to keep in mind again, the ROEs need to start inching up. They've already done an equity issuance and likely that will pressure the ROEs further. But the ROC is very healthy overall. So that's something to again consider. When you're looking at the shareholding pattern, 62% is owned by the promoters, very strongly held by the promoter group. FIs hold around 11, DIs hold around a single digit, and then you have public holding around 26%. So that's broadly the structure. Promoters have good holdings despite the dilution that is happening, and promoters have also participated in the QIP, so ideally shouldn't be too much of a dilution per se. That 62% is reflecting the dilution which has happened. When you're looking at the analyst recommendation, 7 buy calls, no holds, no sells, 12% upside is what the street is penciling in on this one. We're neutral largely because you've just got a 12% upside per se, and the stock price has run up quite a bit. We saw that at the start. Let's look at valuations. It trades at 21 times 1 year forward. Mind you, it does very strong growth for that. FY27 growth is expected to be around 15%. That's the guidance. FY28 though is expected to be between 20 and 25%. So the growth will pick up starting FY28, and the margins will keep getting better. The essential component is cash flow, and we'll quiz management on that. But broadly, this is how we're structured. Basis the 2-year average, I beg your pardon, and the 2-year range. So we're somewhere in the midpoint of that, and hence we've given this one a neutral. Let me in fact go across. We have Sharan Bansal joining us. He's director at Skipper, joining us this afternoon to give us a perspective. Sharan, great having you. Been a while. Thank you so much for joining. And let me first start off with Q1 FY27. Sharan, conversion just 4% YOY. Is that a little bit of Middle East and a little bit of labor issues which are weighing on your top line? Is that the right way to think of Q1? And does FY27 otherwise look okay from a 15% growth that you've guided? Can you do better? Will it be lower? Give us a sense.
Hi, thank you for the question. Yes, there are 3 reasons why the Q1 revenue growth is at about 5% only, despite our overall revenue guidance of 15% for the year, which we still maintain, of course. And the 3 reasons are, the first one being that last year in FY26, we saw slower than expected order inflows, both on the domestic side and on the export side. Domestic side primarily because of the problems being faced in the industry due to ROW and due to equipment shortages. Why? Because of that, Ministry of Power held back some bidding last year, but this year we see a sharp rebound of that. On the export side also, the various geopolitical and tariff related uncertainties kept the order ramp up, prevented the order ramp up from happening on the export side. So that was reason number 1, a lower than expected order inflow in FY26. The second reason was the current geopolitical issues and the sea freight, which is basically preventing the short-term orders from flowing in, and customers are preferring to defer their lifting to later part of the year when sea freight normalize again. The third reason, of course, which you rightly mentioned, has also been labor issues, primarily in first quarter due to Bengal elections. So I'd say that despite these 3 reasons, we have had a resilient growth. We have still given reasonable growth numbers at 5%. And we still maintain our full year growth guidance of 15%. But more importantly, we are also still maintaining our bottom line growth guidance of 30% for the year on account of improved margins. So that's what we are happy about, and we are still maintaining the growth guidance for the year.
Yes, you've done, in fact, very well. I'll ask you 2 follow-ups on what you've told me before I come to order book. One is on the margin count. You've done very well on margins. So what's caused that uptake despite revenue being, largely flat, given your record? Margins have done well. What's driving that?
We are certainly carrying a lot less of the legacy low margin contracts which we had in the past. Most of them have been executed now in FY26, and we carry almost a negligible number of that in our order book, in our current order book. So the new contracts are definitely coming with better margins, and we have guided that our long-term aspirational margins are to go to 12%. So we are very well on track for that. We have managed to improve margins last year as well by about 50 basis points, and we expect a similar margin improvement this year as well.
Raw material prices, is how is the flow through of raw material prices working out for you? Give us a sense. Is it a clear flow through basis the contracts that you've won?
No, we have a combination of both variable price and firm price contracts. And in variable price contracts, obviously, the pass-through is immediate based on monthly adjustment of indices. But on firm price contracts, we carry the risk of raw material. And we then deploy measures of hedging and as well as some inventory stocking to secure ourselves, secure our raw material prices. Keep in mind that there is a fair amount of value addition on our products as well. So raw materials make up just about 60% of our selling price. And engineering revenue has also been growing in the company. So I would say that overall, we are in a comfortable position to deal with the raw material prices.
Okay. Sharan, I'm going to have to take a very short break. It's a mandatory commercial, unfortunately. I need to take that, come back to you on the other side. Stay with us, viewers. Welcome back, and we're speaking with Sharan Bansal. He's director at Skipper, giving us a perspective of the numbers for Q1 as well as what the outlook for FY27 looks like. Sharan, you mentioned that, two headwinds. One is obviously the order book. Right, and Middle East and shipping, which is what is creating a drag, especially on the export opportunity along with tariffs. Give us a sense, if any of these were to unwind, say tariffs were to unwind, say the Middle East situation were to resolve itself, how quickly can order book or orders from there start to materialize or translate, in your opinion, and how much can your margins get better by as a result of this?
Yes, very relevant. So like I mentioned earlier, we have seen a good rebound in ordering this year. In Q1 itself, we took in orders of about 1,600 crores. And in Q2 also looks to be on the right track. So overall, for the full year, we are quite confident that we will be doing 7,000 crores plus of order inflows. And this will be both from the domestic side as well as exports. In fact, on exports, we are particularly happy that we are actually expecting close to about a 50% jump over last year's order inflow. Of course, last year was a lower than expected order inflow, but we are expecting a 50% jump on that number. And more importantly, we are starting to see traction from the developed markets in the export side. So both from our markets in Australia as well as North America, we are seeing some very good order conversion happening. So that's something which we are very happy about. And in fact, in North America now, for the first time, they are going to be doing 765 kV projects. And Skipper has very strong experience and credentials in the 765 kV business. So that will definitely help in ramping up our export order inflow. And for sure, since exports come with better margins, and more particularly developed country exports come with even better margins, we think that our journey towards our long-term aspirational margins of 12% will become faster because of this.
Okay, so, but has it started to translate already? So despite the kind of shipping and freight costs that are there, you're already starting to see traction from export markets?
Yes, we are already starting to see traction, and the shipping, etc. I believe that this is a temporary disruption. We expect that by end of the year, the situation will normalize. And anyway, the orders that we take in this year will mostly be due for execution from next year onwards. We are carrying a comfortable order book of 9,200 crores, which you mentioned. So we anyway do have good revenue visibility for the next 2 years. But what is important is for the next year, sharp ramp up to happen on the revenue and margin side. This year's order inflow are important, and we are seeing good traction and good conversion already starting to take place in that.
Okay. Sharan, making all of these assumptions, and if I've done the math right, you'll be at roughly 10,000 crore in terms of order book if you do the full 7,000 crore of wins. And let's assume that you do that. Broadly, out of the 10,000 crore, how much would be export and how much would be domestic? Can you give us some color on that? Because right now that 9% number is looking a little softer even versus your own aspirations. So I'm just trying to get a sense.
Sure. So long term, what we expect is that exports should move in from our sub 10% order book, sub 10% in our order book to 50%. And of course, that will take a few years to get there. This year, I think we'll be happy if we end up with a 15% mix of exports to in the overall order book. But like I mentioned, what is important for us is that we are seeing inflows coming in not just from our traditional markets of Middle East, Africa, and Latin America, but we are starting to see inflows from the developed markets in North America and Australia as well. So if I look at our long-term order book of 50% of exports, then half of that, which is say 25%, we expect to see from developed markets, another 25% from developing markets, and 50% from domestic. That is the composition long term that we expect to see in our order book.
That'll be very sharp. You know, I mean, you're saying that out of the 10,000 crore book, 1,500 crore will be export, which right now is only 800 crore. And you've done around, I believe, around 1,500 to 2,000 crore of order wins have already come through. So on the balance 5,000, you'll do almost 700 to 800 crore of additional export orders, which is quite sharp, frankly. So, but that's very heartening to hear. The other piece is I'm trying to understand, at the end of Q4, there were some receivables which unwound only in early April. Does cash flow unwind happen materially in this year? And does the receivable cycle really take a turn? Is this the inflection point from that perspective?
The Q4 receivables at the end of Q4 was, due to a technical reason at our largest customer, Power Grid's end, and most of those payments were realized in the first week of April itself. So we are very comfortable where the receivables are concerned. Our customers are all very, very high standard and very cash-rich companies. So we don't expect to see any problems on the receivable. We haven't faced any significant problems in the past as well. And in terms of overall cash flow conversion, we had achieved close to about a 60% cash flow conversion from EBITDA last year, which we expect that should be 75% this year. And on the free cash flow side, even after CapEx, we expect to be very much positive. So I think it's definitely with the improving margins and operating leverage and controlled working capital cycles, we certainly do expect that cash flow numbers will also see an improvement, just the way margin numbers are seeing improvement.
Right. Now, you spoke about profitability, and you said FY27 profit growth will be 30%, and you've maintained that. Very impressive. The only key question is you've done a QIP, and therefore some part of your debt gets paid down. So you get that tailwind as well. Just talk to us about how much of that profit element comes from margins and how much comes from the interest cost saving that happens.
So we had guided for this 30% growth in bottom line even before the fundraise. And so whatever benefit that we will get on the bottom line due to the fundraise will be over and above this 30%. So we maintain that the 30% growth in bottom line is purely due to operating leverage and better quality contracts. And subsequently, the fundraise, which now the money we have just realized in the first week of August, that we will get the benefit in the remaining months, in the remaining 7 to 8 months for this year. So that benefit will be over and above additional this 30%.
Got it. 75,000 tons of capacity expansion. How is capacity utilization playing out for you? Give us a sense. You get to 600,000 tons FY28. What are the timelines for that? Is it going to be one shot from 450 to 600K, or is it going to be slightly different? Last off, sorry, I'm clubbing 2-3 questions here. So one is on capacity and utilization and ramp up. The second piece is to try and understand how the opportunity around substation EPC is getting captured by you.
Surely. So in terms of capacity utilization, we are at about 80% right now. And our capacity expansion is very much on the cards. We are expecting to reach a capacity of 450,000 tons by the end of Q2, which is next month itself. The capacity expansion towards 600,000 will also happen in a phased manner. We expect that this should be completed by FY29, not FY28 perhaps. And in terms of the substation opportunity, we are very excited because of the overall 9 trillion rupees investment into the Indian transmission sector by 2032. Roughly half of that is to go towards the substation segment. And that was a market not tapped by us so far. So now with substations getting into our addressable market, we are quite excited about the growth opportunity in the substation and that further growth opportunity that brings to the company in terms of top line and bottom line.
Okay, Sharan, thank you so much for coming in, giving us that perspective. Very clear with regard to the guidances you've given. So I must credit you for that. Thanks so much for coming in. All right, completely timed out on this edition of All About Your Company, viewers. That's all the time we have. Thank you so much for tuning in. And it's a goodbye from all of us who put this show together.